In Texas, the pickup truck is the ultimate symbol of identity and prosperity. Drive down any major highway in the state, and you are surrounded by a sea of massive, lifted Fords, Chevys, and Rams. Look beneath the shiny chrome and the oversized off-road tires, and you find something else entirely. Those trucks are rolling monuments to a terrifying mountain of subprime consumer debt. The average sale price of a new pickup in the United States has climbed past $64,000. If you look at luxury trims dominating the Texas suburbs, vehicles like the F-350 Platinum or Ram High Country, window stickers regularly surpass $100,000. Most people do not have six figures in cash to spend on a vehicle. Dealerships kept the monthly payments looking affordable by stretching out the financing. Standard 5-year terms quietly expanded to 72 months, then 84 months, and now even 96 months. This visual shows the rapid depreciation curve of a new truck plotted against the extremely slow principal reduction of an 84-month auto loan. When you stretch a loan over 7 years, you barely chip away at the principal during the first 36 months. Meanwhile, the vehicle loses roughly a third of its value. Buyers end up in a state of negative equity, meaning they owe the bank far more than the truck is actually worth. To keep buying new vehicles, consumers simply rolled their outstanding debt from the old truck into the new 84-month loan. Because of this massive mathematical gap, everyday Texans drove off the dealership lot hopelessly underwater. They financed $65,000 trucks, but carried $80,000 or $90,000 in actual debt. The modern Texan symbol of success was a mathematical trap. It relied entirely on an unsustainable foundation of cheap oil, 0% interest rates, and an endlessly expanding credit line. By early 2026, that foundation cracked. A perfect economic storm finally shattered the illusion of affordability across the state. 3 specific triggers hit the Texas economy simultaneously. The oil and gas sector contracted, wiping out tens of thousands of high-paying jobs. Average full-coverage auto insurance premiums spiked by 47%, and average interest rates on used vehicles soared past 12%. Consider the median default profile in this crisis. We'll look at a 3223. He financed a $62,000 Ram 1500 with a 72-month loan. In January 2026, the Permian Basin contracted, and his employer lost 3 major projects. He was laid off. Over the next 2 months, he drained his entire savings account to cover rent, groceries, and that $800 a month truck payment. By March, the cash ran out, and he missed his first payment. The climax of his financial ruin arrived quietly in the dead of night. He woke up to an empty driveway as his primary means of transportation was hitched to a tow truck and hauled away. This individual tragedy is happening tens of thousands of times across the state. It is the inevitable mathematical conclusion of a predatory lending system colliding with a sudden economic shock. In just the first quarter of 2026, Texas saw an astonishing 147,000 vehicle repossessions. That is a 58% increase over pre-pandemic levels. This flood of defaults has turned once profitable dealerships into massive parking lots of unsellable inventory. Dealers are currently choking on a 90 to 120-day supply of used trucks. Every single day those vehicles sit unsold, the dealerships bleed capital by paying interest on their own flooring loans. Back at the auction house, our Fort Worth workers' repossessed Ram sells for just $34,000. After the bank applies that money to his original loan, plus auction and towing fees, he is left with a deficiency balance. He is now legally responsible for a $23,000 bill. These repossessions serve as financial death sentences, chaining families to a decade of debt for a vehicle they no longer even possess. The fallout from these repossessions does not stop at the Texas border. It's a systemic financial shock spreading to the institutional lenders backing the macroeconomy. Wall Street financial institutions took these highly risky 84-month Texas truck loans and bundled them together. They packaged them into bonds known as asset-backed securities, or ABS, and sold them to pension funds and foreign investors as stable investments. This chart from the Encino Research Institute shows average auto loan delinquencies by credit score. Notice the massive spike in the light blue line at the top. This visually proves that poor credit delinquencies hit a staggering 9.04% by late 2025, a pace mirroring the 2008 financial crisis. That 9.04% delinquency rate is actively bleeding local credit unions and mid-sized lenders across the South. Internal documents reveal that major institutions like Capital One Auto Finance are bracing for $340 million in losses on their Texas auto portfolios alone. When the rating agencies downgrade these toxic auto loan securities to reflect the actual risk, it will trigger an automatic wave of forced selling among institutional investors. The collapse of the Texas truck market is actively metastasizing. It is leaching into the global credit markets that fuel the broader American economy. Back on the ground in Texas, the auto repossession crisis is colliding with a broader unaffordability nightmare. Families are already drowning under soaring property taxes, aggressive insurance rate hikes, and inflated housing costs. The average credit score in Texas dropped 31 points between early 2025 and 2026. This credit destruction creates a secondary economic crisis, locking hundreds of thousands out of future mortgages, standard loans, and basic apartment rentals for years. Because these families are funneling their remaining cash into paying off $18,000 to $20,000 deficiency balances, consumer spending across the entire state is rapidly evaporating. Restaurant sales, retail purchases, and entertainment spending are all contracting. The peak default rates for those dangerous 84-month loans originated back in 2023 and 2024 will not hit until late 2026. The facade of modern American wealth has been stripped away. It reveals a middle class dangerously addicted to predatory credit, now facing a severe reckoning that will reshape the financial landscape for the next